All right, everyone. Welcome to the Forgotten Money YouTube channel. And as usual, we will go through some of the weekly analysis videos, or maybe I can say that some of the data we had from last week and some of the data we are getting this week. It is very important, according to me, that we must look what has happened in the last week and what data we are gonna get in our upcoming week. With using this some sort of knowledge, we can make good decisions in our trading journey and can have some good trades across the major asset classes. Now, first, as usual, we will go through first of all from the last week, what scoop of data we had, starting from Monday, August 26th. First, looking at the Eurozone, German IFO business climate data we had. This is not something moved a needle in the market, but it's just something to keep an eye on. 86.6. This wasn't any some sort of a good data. It just stayed close to what the market has consensus from the prior. Core durable goods orders and durable good orders from US dollar, pretty much mixed bag what we got on Monday, August 26th. From China Conference Board leading index, we haven't had any consensus on that, and the data landed on 0.0%, with marginal, I think, marginal reasons, negative 0.7 to negative 0.3. Other than that, we haven't had anything much to look for. Moving to the next day, Tuesday, August 27th, we had Bank of Japan core CPI year of year, and it came worse than expected. Market was actually expecting that the inflation rate gonna stay same as we had prior, but it eventually surprised the market with coming below consensus 1.8%. So if we just look at the Bank of Japan, and we understand that they are currently trying to put the inflation up so that they can get rid of that ultra loose monetary policy. But with these some sort of data, when we get this data, so it really makes very hard for those the central bank to go away from their monetary easy policy, and they might have to stick with that for longer than they thought. So if we just talk about just about the CPI, there are two releases we had. First one is from the Tokyo CPI year of year, which considered as a leading indicator. Probably market just realized where this Bank of Japan CPI nationwide data gonna land, from the data that they get from the Tokyo CPI. If the Tokyo CPI comes in worse than expected, then probably there are high chances that market already set up their mind that the nation's CPI report gonna come worse than expected. Now, with that being said, as we can see, as we are seeing here, it just came worse than expected, 1.8%. So I I don't believe that it moved the market in any way, because the yen stayed pretty much strong for last week. There wasn't any particular reason for that. If I guess, there was maybe the reason we can give it to the month end flows that we had last week. The price action was pretty much choppy, but we do had some good trades, and we will talk about it later in this video. Moving forward, let's just jump on 10 a.m. Atlantic Standard Time. S&P Composite 20 house purchase index year of year. Nothing something that we look to trade out of this data. However, it just came in close to the consensus, 6.5%. A Richmond Manufacturing Index, something to keep an eye on, just came a little bit worse, negative 19. So we don't trade solely just this data, because if we look at the graph, this data is so noisy that there is no point of trading it. It always sometimes comes worse than market expect, way worse, or it just came way better than market could have anticipated. So it's really noisy, so there is no point trading this data. Looking forward at Conference Board Consumer Confidence, it's stating that the U.S. economy is having a really good confidence in their economy, and the consumer confidence data came better than expected. Also, we got the reason going up from 100.3 to 101.9. So, something to look on August 27 was the CPI year of year. It came a little bit upside from what market has anticipated, but if you look at this data, it came worse than that. 3.8% what the Australian CPI was, and I think July CPI report came in 3.5%, which is technically, if we look at from a RBA perspective, they had been really hawkish from their commentary on the last meeting. They were saying that they are open to increase the interest rates if they see that the inflation is not heading to their right path. So with that, overall, it is a good number. The inflation is heading where the central bank wanted, uh, but the market was expecting more decline in the inflation than the central bank. So it was a little bit up surprise, but it wasn't that much. So we also had some other CPI figures from Australia, but because of factory, it has a limited source, or let's just say it's just a free version, so we don't get major or much of macro event data out of it. So there are so in order to get a better picture of these data, there are some good calendars we can look for, which can clearly give us a nice edge on each data, what exactly the market is looking for with the forecast distributions on it. So overall, it was perfectly going in a right direction. If I just move it to the line graph, if you can look, it's just going in a right path. Moving forward to the next day, we haven't had any comment from Fed Waller so far I remember, but however I haven't recorded anything from Waller's side that he had made any major comments out of his speech. Crude oil inventories we had came worse than expected. Let me just see how worse it was. The market was expecting negative 2.7 million, but we got I think negative 0.8 million, which eventually is if we look at the description here, it says uh, primary gauge demand imbalances the market, which can lead to change in production levels. So actual less than forecast is good for currency. So the lesser it is, the good for it is for the currency. Just like unemployment claims, unemployment claims, if it comes worse than expected, then it is good for the U.S. dollar, because less people are claiming from the government. Moving forward to the Thursday, August 29th, this is the one where we had some major data out of US, preliminary GDP quarter of quarter and unemployment claims. and prelim GDP price index quarter and quarter. So we had 3.0%, which is stating that the US has a pretty solid growth. It is growing very nicely, even though the market has shifted its focus from inflation to the labor market. However, looking at the growth, if the growth stays above what the FOMC expecting, that if we look at the FOMC summary of projections SOP, it is stating that by the end of 2024, the US economy is going to get slowed. It's going to get to the 2%. Uh, but we are with this data, it is showing that the economy is doing really great, and this was the trigger that led us to buy the dollar and short the euro. Why we short the euro? Because we had German preliminary CPI month on month, also Spanish flash CPI year of year. Both came in worse than expected. That was leading a sell off in euro, and a good data we had, which eventually gave us a reason to get in euro USD short. So after that, we had pending home sales came was than expected, nothing major to look for. The comments we had from SNB chairman Jordan, I think if I remember that the comments was something that the stronger Swiss franc is hurting the economy, and we no and also the weaker euro is also hurting their economy, because stronger Swiss franc making hard for the exporters to export their inventories. So as I mentioned earlier, probably you remember it. Tokyo's core CPI we had, and lastly we looked at Bank of Japan core CPI. This is the last month, and where is it? Okay, so here it meant to be a leading indicator. So if we can see that 2.4%, so probably we can expect that the national CPI year of year is expected, or maybe can come higher than forecast. It's probably gonna get landed higher than forecast. Looking at the unemployment rate, it just ticked higher, 2.7% from 2.5%. It can seen as a worst, but if from a logical point of view, the majority of the central banks try to reach at 5%, not above from 5%, but close to 5%. So it still is really far from 5% goal. Now on Friday, it was a quiet day, if I to be honest with you guys. Uh, Nothing major to look at. CPI flash estimate. It's just a lagging indicator, because we already had German and Spanish CPI last yesterday, so there is something to look to get out of this event. GDP month on month from Canada, we had 0.0%. A core PCE index came just in line with the market expectation. There wasn't anything. Chicago PMI a little bit better. And lastly, we had majorly manufacturing PMI and non-manufacturing PMI from China side. Oh, I am tired. Anyway, so manufacturing PMIs came worse, but not that worse that can shock the market. It's just we can see that it's just in line with the expectations, not worse than expected. So, what data we can keep in mind from last week? That's the thing we need to ask ourselves. GDP from US side is one of the major event we had, and also inflation reports we had from Eurozone is something to keep in the mind before moving to the next week, that the US economy is in a strong growth, and the inflation in Eurozone is declining and in line with the ECB's I think projections, if I'm not wrong with that. So now let's move to the next week. The next week uh, has a lot of fireworks to work on. Okay, so forget about Sunday. Monday, it's gonna be thin liquidity day. Canada, we are having a Labor Day and also a holiday on US, so major participants gonna be away from their desks on Monday. So not a good day to waste our energy on looking at these screens when we know that there is gonna be a thin liquidity. Major event starts on Tuesday when everyone comes back to their desks, starting with CPI month on month from Switzerland. So, following in July, we had 1.3% year of year inflation out of Switzerland. And for the quarter as a whole, the S&B forecast inflation for the quarter three is 1.5%. And if we just look at the last month, July, 1.3%, I mean, it is really low what the S&B has been expecting. And it can give S&B another reason to cut their rates, which eventually can lead to sell off in a Swiss franc. So the next print we're gonna have on 3:30 a.m. Market is expecting 0.1% from prior 0.2%. So with this data, if it comes better than expected, it eventually give a bank reason that they should hold their horses, but it's not going to be major. I think if we want to trade out of this event, we need to have a major deviation from the forecast. I mean, point 3 to 5, anything above that number can trigger the market. Below 0.1%, I mean, there can be a tradable opportunity out of that, but I'm not keen to short the Swiss franc as it already got a lot of if I'm not wrong, let me just bring that for you. Where is it? It was just somewhere. Okay, yep, right here. So so if we look at the Swiss franc, just look at how much strength it got actually. So sorry about that. I think if that's the strength we are seeing in a Swiss franc, I mean, looking at the miss is gonna give us the major opportunity. And if we do get a huge miss, and if we break this level, we can clearly target for the next resistance support level at 0.834. Out of that, And also on the next meeting probably we're gonna have on, I think I had wrote that date, but might be confusing with that. So anyway, the market is currently expecting a cut from the S&B in the next meeting, and also the market has priced in 33 basis of points worth of cuts by the end of this year from the S&B. And also as a reminder, September is going to be the last meeting with Chairman Jordan, and he will be replaced by current Vice Chairman. I don't know his name, but this meeting is going to be the last meeting from Swiss National Bank Chairman Jordan. Other than that, we also had some major comments from Swissmen, said that fair value for Euro Swiss franc was 0.98, and at that time it was at 0.92, and they called S1B to wiggle a little to create some weakness in the currency, because they are already having a lower inflation, and S&B can afford to allow the currency to weaken just a little bit. So that what the Jordan acknowledged in his last remarks, by saying that the exchange rate makes the situation difficult for the Swiss industry. Now, with that, moving forward, we also gonna have GDP quarter from Swiss National Bank. Uh, so it's expected to stay at 0.5%. Now, if we get any if we get a stronger growth, that can lead Swiss franc further bulls to take control. If we get worse, I mean there is a two-way opportunity, but we will see what we get from this data. Lastly, the major event we're gonna have out of US ISM manufacturing PMIs. So the market consensus it is to tick a little bit higher, and don't forget that we also had S&P Global Flash PMI data for Augusta, which showed that the manufacturing PMI just fall down from 49.6 to 48.0, signaling deterioration in business conditions for a second straight month. So with that, there are other components is gonna get released. The ISM manufacturing comes in with the five sub components, and one of them is employment index. So that's one gonna be the major key data, because as we know that FOMC is highly very vigilant, if we can say that, on employment side. So that's one we're going to be paying attention to. Broadly, we're going to be looking for a beat or miss, for to do a short run scalp out of it. GDP quarter out of Australia is something to look for. 0.2% is what the market is expecting. Now, after that, Wednesday, we are having a central bank coming out at 10:45 a.m. Atlantic Standard Time. It's going to be Bank of Canada, and the expectations that they're going to cut by 25 basis points, and this is going to be the third cut straight in a row, and also the market is expecting a total of three cuts by the end of this year. uh, and I personally believe that it is reasonable for them to do cuts by the end of this year by 75 basis points. The market is not pricing that wrong. In July, Governor McCallum noted that if inflation continues to ease broadly in line with their forecast, it is reasonable to expect further cuts in the policy interest rate. So the Governor McCallum stayed pretty much dovish in his last meeting, and and it is reasonable that they're staying dovish. And also in the statement, he acknowledged that the risks to the inflation outlook are balanced. Uh, they just dropped their language from April that the Bank of Canada was more concerned about upside risks. If we look at the data, inflation data out of July saw average of the Bank of Canada core Myers east to 2.43%, also revised prior down to 2.57%, just fueled the rate cut expectations. And the July jobs report saw a decline on the headline. So the unemployment rate just stayed 6.4%. Nonetheless, with the slowing growth and inflation seemingly returning to the target, the Bank of Canada has scope to continue with 25 basis point of rate cuts by the next meeting on Wednesday. So I'm believing that they're gonna be dovish as usual. But how dovish they're gonna be, we will look for it. Jolts job opening data is something to keep an eye on because after all, it belongs to the labor data. A press conference is after the 45 minutes, and this is the major RBA Governor Bullock speaking. Something to keep an eye. Moving forward to Thursday. Okay, so ADP, it is noisy. I don't believe the markets really put focus on ADP data because it randomly aligned with NFP. So, I mean, with this current environment, as the market is, even though FOMC is hugely focused on labor data, I think it can make the market to move in any direction if we get a beat. The beat must have to be really, really out of the deviation that can surprise the whole market, or the worst in any way. Uh, if it comes the word, it can create some sort of fear in the market that the Fed is really behind the curve. But but the comments we had from some of the FOMC members, they're saying that, hey, we know what doing. The labor market just surprisingly went lower, and the unemployment rate just ticked higher than we had anticipated. But there is nothing to worry about that. So as I said, it's a labor data, and it can make the market to move. With just after 50 men, we're gonna have some unemployment claims, and the major data after that, ISM services PMI, same as we are gonna have we with the if we compare it with the manufacturing PMI, there are gonna be five components, subcomponents, and employment index is going to be one of the major. And if we look at the last S&P global flash PMI services, that just show that the services index has been doing pretty much great, and which eventually fueled into the GDP. The numbers we had last week came strong. Believe the market believe that this is because of the services is pretty much staying strong in the US. Friday, I think I don't have to explain it to you all. You already know it's NFP day, and when it's NFP day, a market is gonna be hugely focused on this data along with the FOMC. So the recent article I have read, and the economist, I don't believe he's too much wrong about it. So he said that the last month we had some really, really disturbing data out of the US, but with the With that, he believed that the reason can be given to hurricane that the US had, which really put a huge impact on the US labor market. And according to that, with that, as temporary laid off working will return to their jobs in August, the unemployment rate would drop back to 4.2%, and possibly it may can drop to 4.51%. And I do some sort of believe that the labor data can come to strong. If we look at the consensus, 4.2% is what the market is expecting, a little tick lower from the prior, and NFP and the average. So the market is expecting a strong labor data. Stock market is not pricing in, trying to price in the worst, but they do believe that that data can come better than expected. So this is all we gonna have from a macro event point of view, and there's plenty to look for. There are so many trades we can do out of these events. So that is the end of the video, I guess. And if you have any comments, don't hesitate to let me know, and I will be more than happy to answer all of your questions. Thank you very much.